Welcome to the debate. Today we are diving into the complex financial landscape of Figma, Inc., based on their Form 10Q for the quarter ended June 30, 2025. This document, well, it captures a moment of massive upheaval. You've got the fallout from the abandoned Adobe merger, and then this subsequent transformation into a publicly reporting company. The numbers are frankly incredibly volatile. So the central question before us is pretty critical. Does Figma's use of non-GAAP reporting provide the, let's say, essential, normalized view needed to assess its true underlying operational health? Or does it actually serve primarily to obscure the massive economic costs and financial risks inherent in its structure?
So the central question before us is pretty critical.
I'm going to argue that these non-GAAP metrics are absolutely indispensable for isolating and evaluating the company's powerful growth trajectory, which otherwise just remains hidden beneath, extraordinary non-recurring accounting noise.
And I'll be taking the opposing view. While I appreciate the need for normalization after such a transformative period, I really believe that relying heavily on the adjusted non-GAAP figures offers a deceptively clean picture of operational success. The full GAAP results, particularly when we focus on the enduring scale of equity compensation, reveal fundamental economic liabilities and financial dilution risks that investors simply cannot afford to disregard. What you're calling noise is, I think, actually the economic realization of their core business model.
Okay, so my position is really rooted in the sheer unreadability of the GAAP statements for the comparative period. I mean, to understand Figma's structural profitability, you simply have to strip away the shockwave of 2024. For example, in Q2 2024, the income loss from operations was just a staggering negative figure, nearly $900 million. The specific number, $894.287 million, was overwhelmingly driven by $858.390 million in stock-based compensation expense, and this was tied directly to the May 2024 RSU release. Look, this wasn't normal payroll. This was a massive one-time compensation event designed to allow employee liquidity ahead of the potential IPO. So, excluding that unique distortion lets us see the real, rapid operational progress. Non-GAAP operating income for Q2 2025 was $11.472 million. That's a huge jump from $4.880 million the previous year. And furthermore, the non-GAAP view of liquidity. It shows adjusted free cash flow, shifting from using nearly $180 million in the first half of 2024 to actually providing $155.185 million in 2025. That's a 33% margin. This evidence, I think, confirms a highly profitable, rapidly scaling enterprise driven by that 41% year-over-year revenue growth.
Right. That is a compelling presentation of recovery. I'll grant you that. But I would frame the cost very differently. That GAAP loss, extreme as it was, over $814 million in the first half of 2024, represented the true expense of capital needed to retain talent during that period of immense uncertainty. When you exclude stock-based compensation, or SBC, from non-GAAP metrics, you are effectively ignoring the full cost of labor. Even looking at Q2 2025, which you're claiming is clean, they still excluded, $7.310 million in SBC just to calculate that non-GAAP profitability. More critically, this reliance on equity creates substantial future liabilities. The company's financial future is burdened by over $1.5 billion in total unrecognized stock-based compensation related just to RSUs alone. And importantly, that figure doesn't even account for the hundreds of millions tied up in the complex new CEO market-based and service-based awards granted in 2025. These are not phantom costs. They represent guaranteed future dilution for shareholders. So ignoring them creates an artificially flattering operational-only profitability picture, which contrasts pretty sharply with the minimal Q2 2025 GAAP net income of just $28.227 million.
Okay, I see why you characterized SBC as a core cost, but I think we really need to distinguish between the two types of costs here. You've got the historic anomaly versus the structural path forward. We have to accept that the $801.2 million RSU charge in 2024 was an explicit transaction tied to the IPO preparation. It just wasn't an ongoing structural expense in the same way. And the proof of structural efficiency is actually visible in the unadjusted GAAP numbers themselves. Look at the gross margin. It jumped from 78% in Q2 2024 to an extraordinary 89% in Q 2025. That's an 11-point leap. It's a direct result of improved leverage and scale in their subscription delivery. This, combined with the improvement in non-GAAP operating margins from 3% to 5% quarter over quarter, demonstrates that profitability is driven by rapid growth and inherent operational leverage, not just, creative accounting.
I'm sorry, but I just don't buy that the compensation structure can be compartmentalized as simply noise that we can just adjust away. While I'll concede the 89% GAAP gross margin is a strong structural indicator, that operational efficiency is being funded by the persistent reliance on high-volume equity grants. You are essentially sacrificing future shareholder value for present operational margin. Even setting aside the 24 event, the ongoing reliance on high SBC means massive future dilution is pretty much inevitable. That $1.5 billion in unrecognized compensation, it's projected to be recognized over an average of, 2.3 years? And what does dilution mean in practice? It means every existing share is worth less because the ownership pie is constantly being sliced into more pieces to service these compensation promises.
But surely that dilution risk is factored into the market value already. The question is whether the operational success justifies that cost. Non-GAAP helps us confirm the operational engine is running smoothly, generating the growth that justifies the equity issuance in the first place.
I would argue that the non-GAAP metrics fail to adequately signal the risk because that dilution is inextricably linked to governance. The filing explicitly cites the highly concentrated voting power held by the CEO, Dylan Field, who controls approximately 73.4% of the voting power post-IPO. This control is reinforced by the multi-class structure and these contractual agreements, including something known as the Wallace Proxy. For listeners, the Wallace Proxy is basically a long-term contractual voting agreement that reinforces the CEO's control over decision-making, separate from his individual equity stake. So when you combine this concentrated control with the need to service billions in future SBC, including hundreds of millions in his own specific 2025 awards, you create a situation where management control is pretty insulated from the financial dilution necessary to retain key personnel. The non-GAAP P&L completely misses this crucial shareholder risk factor.
Look, you're focusing on the governance structure, which is, let's be honest, a static risk factor, rather than the demonstrated dynamic performance. The non-GAAP P&L and free cash flow are designed to be dynamic tools, showing management's execution on growth and margin. If they didn't adjust for SBC, the operational P&L would be constantly obscured by these accounting entries that, frankly, do not reflect cash flow or immediate decision-making efficiency.
Okay, but I come at it from a different way when looking at liquidity, because the adjustments made in the cash flow statement are perhaps even more revealing. You praised the shift to a positive cash flow of $159.632 million from operating activities in the first half of 2025. And yes, that's a major reversal from the cash burn in 2024. However, let's really scrutinize that adjusted free cash flow calculation. In 2024, the operational cash flow was severely reduced, partly due to a real massive cash outflow, the $185.6 million in estimated income taxes related to the abandoned merger with Adobe. So the company is essentially asking us to normalize away a 9-figure real cash tax payment resulting from a highly impactful corporate transaction.
But the normalization is absolutely critical. That tax payment related to the Adobe breakup fee is entirely non-recurring. It's not indicative of the core subscription business's ability to generate cash moving forward. The whole purpose of adjusted free cash flow is to show the cash generated from selling software and servicing customers. That tax bill was a relic of a failed M&A attempt, plain and simple.
But the risk that large non-recurring tax or litigation liabilities might materialize is precisely what GAAP is designed to capture. By adjusting it away, you mask the inherent volatility of a company that engages in these kinds of high-impact corporate maneuvers.
Okay, but we have tangible evidence of robust capital management that supports the adjusted view. Subsequent to the period end, the company established a $500 million revolving credit facility. They then used $330.5 million of that facility to handle tax withholding related to the RSU vesting post-IPO, and then, this is key, immediately repaid it. This action shows disciplined short-term liquidity management and robust access to capital, which aligns perfectly with the healthy $155.185 million adjusted free cash flow margin. This metric correctly tells us the company can fund its operations and strategic investments like the $30 million purchase of digital assets without having to constantly tap the equity markets for daily needs.
That sounds like a defense of their borrowing capacity, not really a defense of the metric that excluded the volatility in the first place. You seem to be using the company's success in managing risk as proof that the risk wasn't significant to begin with.
No, I'm using the metrics to show that the foundation is solid. And beyond liquidity, let's look at the strategic direction. Figma is aggressively expanding its platform, launching major new product lines like Figma Sites, Make, Buzz, and Draw just in 2025. And crucially, they are making heavy investments in AI capabilities. These strategic pivots are reflected clearly in the non-GAAP statements. By isolating the cost of scaling the platform, we see increased technical infrastructure and hosting costs specifically due to AI efforts. Non-GAAP allows investors to more easily track the efficacy of these new strategic investments, separating the necessary R&D ramp-up from the noise of historic compensation adjustments. Management is clearly confident these costs will drive future sustainable growth.
That's a compelling argument for their strategic intent, absolutely. But have you considered the risks embedded in those very investments, as outlined right there in the 10Q? The non-GAAP metrics might provide a smooth trend line for R&D, but they are frankly ill-equipped to capture the underlying strategic uncertainty. The filing explicitly warns that the long-term impact on AI on gross and operating margins is, quote, currently unknown. It raises a really critical risk of AI perhaps cannibalizing their core subscription model by making users so efficient that they actually reduce the number of required subscription seats. So yes, you are seeing the R&D expenditure today, but we don't know the payoff. And the potential failure rate or the liability from regulatory concerns, which they mention, is high. The smooth, upward trending non-GAAP margin picture provides a level of comfort where perhaps deep caution is warranted.
But that level of risk assessment requires qualitative judgment, which, let's face it, beyond the scope of any accounting metric, whether it's GAAP or non-GAAP. What non-GAAP does successfully is quantify the cost of the investment, the R&D, and cost of revenue increases due to AI, and isolate it so we can then measure the subsequent impact on operational margins down the line. The alternative is just to let that signal be completely obscured by the one-time compensation charge from 2024.
My concern remains that the metrics you champion focus almost solely on operational inputs while deliberately obscuring the true capital costs, namely the dilution and the inherent volatility in their strategic decisions. A business built on massive equity grants and aggressive high-risk technological pivots isn't, I believe, accurately reflected by a clean operational profit number that simply erases those very significant factors.
Okay. I believe we've successfully mapped out the core tension here. The non-GAAP perspective, I maintain, powerfully illuminates a structurally sound business that achieves substantial operational profitability and margin improvement in the first half of 2025. It correctly abstracts the extraordinary financial turbulence of the previous year to show a healthy core model driving robust growth.
Conversely, the source material itself compels us to focus on future liabilities. The sheer scale of the unrecognized stock-based compensation, totaling billions of dollars, remains a major economic overhang that GAAP metrics, however volatile they might be, are specifically designed to track. And this liability is, I think, inseparable from the substantial multi-class governance risk cited in the filing, which protects the very management structure that authorizes this compensation.
So ultimately, investors must really perform a dual analysis here. They have to weigh the clear operational success demonstrated by the non-GAAP profitability against the significant future liabilities and volatility inherent in scaling a high-growth company using such a massive volume of equity compensation and, yes, pursuing aggressive technological pivots. It's clear that both views are pretty indispensable for a complete assessment of Figma's financial transition out of this very transformative period. There's still a lot to watch in the coming quarters.